Can you become a billionaire by avoiding tax? In the US, most people make their money from a regular job. They get a paycheck and pay income taxes. But the richest Americans, the top 1%, make most of their money from things like investments in real estate or the stock market. Those investments are taxed as capital gains. While the federal income tax has a maximum tax rate of 37%, the tax rate for capital gains tops out at just 20%. That's why Warren Buffett, one of the richest people in America, has often said that he pays a lower tax rate than his secretary.
She pays at twice the rate I pay. I think that's outrageous.
In 2007, Jeff Bezos, then a multi-billionaire and once the world's richest man, did not pay a penny in federal income taxes. He achieved the feat again in 2011. In 2018, Tesla founder Elon Musk, the richest person in the world, also paid no federal income taxes. Michael Bloomberg managed to do the same in recent years. Billionaire investor Carl Icahn did it twice. George Soros paid no federal income tax 3 years in a row. So, how do men with such dramatically high net worths avoid paying federal income tax? Stay tuned till the end to find out. America's billionaires avail themselves of tax avoidance strategies beyond the reach of ordinary people. Their wealth derives from the skyrocketing value of their assets, like stock and property. Those gains are not defined by U.S. laws as taxable income unless and until the billionaires sell. To capture the financial reality of the richest Americans, we at Billionaire undertook an analysis that has never been done before. We compared how much in taxes the 25 richest Americans paid each year to how much Forbes estimated their wealth grew in that same time period. We're going to call this their true tax rate. The results are stark. According to Forbes, those 25 people saw their worth rise a collective $401 billion from 2014 to 2018. The IRS data shows that they paid a total of $13.6 billion in federal income taxes in those 5 years. That's a staggering sum, but it amounts to a true tax rate of only 3.4%. No one among the 25 wealthiest avoided as much tax as Buffett, the grandpa centibillionaire. That's perhaps surprising, given his public stance as an advocate of higher taxes for the rich. According to Forbes, his riches rose $24.3 billion between 2014 and 2018. Over those years, Buffett reported paying $23.7 million in taxes. That works out to a true tax rate of 0.1%, or less than 10 cents for every $100 he added to his wealth. Experts have long understood the broad outlines of how little the wealthy are taxed by Uncle Sam, and many lay people have long suspected the same thing. Consider Bezos, 2007, one of the years he paid zero in federal income taxes. Amazon's stock more than doubled. According to Forbes, Bezos' fortune leapt $3.8 billion. So, how did a person enjoying that sort of wealth explosion end up paying no income tax? In that year, Bezos, who filed his taxes jointly with his then-wife, Mackenzie Scott, reported a paltry $46 million in income, largely from interest and dividend payments on outside investments. He was able to offset every penny he earned with losses from side investments and various deductions, like interest expenses on debts and the vague catch-all category of other expenses. In 2011, a year in which his wealth held roughly steady at $18 billion, Bezos filed a tax return reporting he lost money. His income that year was more than offset by investment losses. What's more, because, according to the tax law, he made so little he even claimed and received a $4,000 tax credit for his children. His tax avoidance is even more striking if you examine 2006 to 2018. Bezos' wealth increased by $127 billion, according to Forbes, but he reported a total of $6.5 billion in income. The $1.4 billion he paid in personal federal taxes is a massive number. Yet it amounts to a 1.1% true tax rate on the rise in his fortune. If you account for the $127 billion increase to his net worth that came from stocks appreciating in value over time, that $1.4 billion in federal income taxes accounts for just over 1%. Moreover, Bezos and other stockholding billionaires are able to turn those stocks into usable cash without having to sell. By borrowing money against their stock holdings, they're able to lock in a lower loan interest rate than what they would pay through capital gains taxes that are applied after a stock is sold. The concept that income comes only from proceeds when gains are realized has been the bedrock of the U.S. tax system. Wages are taxed, cash dividends are taxed, gains from selling assets are taxed. But if a taxpayer hasn't sold anything, there is no income and therefore no tax. In the here and now, the ultra-wealthy use an array of techniques that aren't available to those of lesser means to get around the tax system. Certainly, there are illegal tax evaders among them, but it turns out billionaires don't have to evade taxes exotically and illicitly. They can avoid them routinely and legally. Most Americans have to work to live. When they do, they get paid and they get taxed. The federal government considers almost every dollar workers earn to be income, and employers take taxes directly out of their paychecks. The Bezoses of the world have no need to be paid a salary. Bezos' Amazon wages have long been set at the middle-class level of around $80,000 a year. For years, there's been something of a competition among elite founder CEOs to go even lower. Steve Jobs took $1 in salary when he returned to Apple in the 1990s. Facebook's Zuckerberg, Oracle's Larry Ellison, and Google's Larry Page have all done the same. Warren Buffett has famously held onto his stock in the company he founded, Berkshire Hathaway, the conglomerate that owns Jayco, Duracell, and significant stakes in American Express and Coca-Cola, that has allowed Buffett to largely avoid transforming his wealth into income. From 2015 through 2018, he reported annual income ranging from $11.6 million to $25 million. That may seem like a lot, but Buffett ranks as roughly the world's 6th richest person. He's worth $110 billion as of Forbes' estimate in May 2021. At least 14,000 U.S. taxpayers in 2015 reported higher income than him. There's also a second strategy Buffett relies on that minimizes income and therefore taxes. Berkshire does not pay a dividend, the sum that many companies pay each quarter to those who own their stock. Buffett has always argued that it is better to use that money to find investments for Berkshire that will further boost the value of shares held by him and other investors. If Berkshire had offered anywhere close to the average dividend in recent years, Buffett would have received over $1 billion in dividend income and owed hundreds of millions in taxes each year. Many Silicon Valley and infotech companies have emulated Buffett's model, eschewing stock dividends, at least for a time. In the 1980s and 1990s, companies like Microsoft and Oracle offered shareholders rocketing growth and profits, but did not pay dividends. Google, Facebook, Amazon, and Tesla do not pay dividends. Other billionaires used less conventional ways to avoid income. Tech mogul Peter Thiel amassed a $5 billion Roth IRA, a type of account that shields income from taxes and is intended to help low- and middle-class savers prepare for retirement. Back in 1999, Thiel stuffed low-valued shares of the company that would become PayPal into the account, a maneuver tax lawyers said risked running afoul of IRS rules. However, it's not clear if the government ever challenged the move. He set himself up to reap billions in untaxed gains. Even when tech billionaires do show income on their tax return, they tend to pay relatively low income tax rates. That's because of the type of income they have. Gains from long-term investments, such as from stock sales, are taxed at a lower rate. But what do you do if you're making over $1 billion every year, and it's largely from short-term trading? Do you just accept that you'll pay a higher rate on all that income? Jeff the Ass, head of one of the most profitable firms on Wall Street, did not meekly accept this fate. Instead, his firm, Susquehanna International Group, found creative ways to transform the wrong sort of income into the right kind, generating tax savings that exceeded $1 billion over just 6 years. The tax code offers business owners a slew of methods to erase income through deductions, none more awesome than buying a sports team, as former Microsoft CEO Steve Ballmer did with the Los Angeles Clippers. It doesn't matter whether the team is actually profitable and growing in value. It can still be a write-off. In some cases, we found, owners could effectively deduct a given player's contract not once, but twice. They're allowed to take deductions comparable to those for factory equipment that loses value as it ages, even as teams almost inevitably gain in value. That's one reason owners tend to pay far lower tax rates than the athletes they employ, or even the people serving beer in the team's stadium. It was found that a Clippers arena worker made $45,000 a year and paid a higher tax rate than the billionaire Ballmer. What it would take for a fundamental overhaul of the U.S. tax system is not clear, but the IRS data illuminates that all of these conversations have been taking place in a vacuum. Neither political leaders nor the public have ever had an accurate picture of how comprehensively the wealthiest Americans avoid paying taxes. Buffett and his fellow billionaires have known this secret for a long time. As Buffett put it in 2011, "There's been class warfare going on for the last 20 years, and my class has won." So, what are your thoughts on this mind-blowing revelations? Do share your views in the comments below. Thanks for watching. Be sure to like and subscribe to our channel with all notifications enabled so that you never miss any exciting updates.